Welcome back to Talk Nerdy to Me, an entrepreneur's financial guide. I'm Michelle Delker, founder and CEO of the William Stanley CFO Group.
And I'm Robin Keithley, VP of Operations here at the William Stanley CFO Group. In each episode, we dive into the financial challenges business owners face and explore real-world solutions to help your business grow and thrive.
That sounds really exciting. Are you excited?
Always.
We're already off script. So today we're tackling a crucial issue, cash flow challenges for companies that are, losing money. Does that happen?
It does happen.
We'll walk through ways to improve profitability, both by growing revenue and controlling costs, and share strategies to manage your cash effectively.
Exactly, Michelle. We'll also discuss external funding options and solutions for companies needing extra liquidity.
Oh my gosh, talk nerdy to me. And in our next episode, we'll have Delilah Berry from Blink Rome join us to dive deeper into financing and negotiating financial instruments. But for now, let's focus on how you can strengthen your business's foundation through revenue growth and cost control. And let's start by addressing one of the biggest mistakes many business owners make when facing cash flow issues. What do you think it is?
I don't know. What is it?
Oh, they focus too heavily on increasing revenue without fixing the underlying cost structure. And I know you've seen this before, right?
Definitely. Growing revenue is important, but if your expenses are growing faster than your sales, you're just accelerating losses. So let's talk about strategies to boost revenue and manage expenses to build a sustainable, profitable business.
Oh my gosh. I feel like maybe we should segue into like a pricing strategy discussion.
Sounds good.
Ooh, so one of the first areas to examine when trying to grow revenue is your pricing strategy. Is your pricing aligned with the value you provide, and are your costs fully accounted for? If you're underpricing, you could be growing revenue, but actually losing money.
A big part of maintaining sustainable growth is regularly evaluating and adjusting your pricing. Prices can't be static. They need to evolve with market trends, competition, and the value you offer.
100%. So many companies miss opportunities to increase prices because they fear they'll lose customers. But if you add value through premium services or improved offerings, customers will often pay more. Gradually raising prices or offering tiered services can also help.
Right. It's not just about pricing. You also want to ensure you have strong market insight and diversified revenue streams. Relying on one product or market can leave you vulnerable, so expanding your reach can help stabilize and grow profitability.
Did you say diversify your revenue streams?
Yes.
Oh my gosh, what a great suggestion. Almost like a critical strategy, because as you said, it's risky to rely on one product or one service or one market, because what if there's a downturn? So it just makes sense to introduce complementary products, not ones that tell you your outfit looks really good, but ones that go really well with what you're already doing, or potentially entering new markets so you can spread that risk and create new growth opportunities.
Exactly. This could mean offering new products, services, or even expanding into new geographic or demographic markets. It's all about creating multiple avenues for revenue so that you're not overly reliant on one source.
Oh my gosh. And you can also look at licensing or affiliate partnerships, right?
Yes.
She says, if there's something in your business, whether it's technology, processes, or intellectual property that others would pay to use, that's an excellent way to open up new revenue channels without major additional expenses.
Preach.
Holla! So now that we've reviewed your pricing, it's important to focus on sustainable revenue growth. So revenue growth must be strategic. Why? Well, if your cost structure can't handle that growth, you'll wind up with ballooning expenses that outpace revenue gains. So let's break down some key strategies for growing revenue effectively.
Yes, let's start with upselling and cross-selling. One of the easiest ways to grow revenue without incurring major new cost is to offer more to your existing customers. They already trust you, so it's easier and cheaper to sell more to them than to acquire new customers.
And it's so often overlooked, but you've already built that relationship, you've demonstrated credibility and trust, and you have a really good understanding of what they need. So upselling premium versions of your products or services, and cross-selling, again, by bundling complementary offerings. So if you offer a core service, add a maintenance or support package. It's not just going to boost your revenue, but it's also going to help service your client better.
Yes, while acquiring new customers is important, one of the best ways to grow is by focusing on customer retention. The longer your customers stay with you, the more they'll spend over time and the more likely they are to refer others.
It makes sense, right? Customer retention is often less expensive than acquisition, and loyal customers tend to spend more. So continue to offer great service, implement loyalty programs, and stay engaged with your clients. And also, another approach potentially is subscription-based models. This helps ensure recurring revenue and deepens those long-term relationships. Oh my gosh, but what else? Maybe let's talk about entering new markets. If growth in your current market is slowing, maybe we consider targeting different customer segments or expanding geographically.
Right, but be cautious. Expanding into new markets without proper research can be risky. Conduct market research, understand your competition, and test the waters before going all in.
I like it. So be cautious. Yes. It's really smart, right? Because with e-commerce and digital services, there's the potential to expand globally without needing to open a physical location, a huge benefit in today's world. But before we proceed with any of these, because we're not just going to move forward with a hope and a prayer, right? We're going to perform the necessary diligence to ensure whatever we're moving forward with makes the most sense.
Exactly. First, you'll need to evaluate your financial health. Review your profit margins and cash flow. If they're too tight, growth could actually hurt more than help.
Yeah, like a cash flow crunch, not having appropriate liquidity. And then next, conduct market research. Is there enough demand in the market to justify the growth? And how does your pricing compare to competitors? And what do your customers really value?
You'll also want to review your operational capacity. Do you have the resources, team, and infrastructure to handle increased demand? If not, you may need to invest in scaling your operations first.
I love that. I mean, the worst thing to do would be to sell something and not be able to fulfill it, or not be able to fulfill it with the same level of quality that you're known for. Mm-hmm. And lastly, my gosh, nobody likes it, but consider your risk exposure. Are you overly reliant on one product or customer? Diversifying your revenue and ensuring your cost structure is scalable are critical steps to avoid potential pitfalls down the road. Oh, managing expenses maybe feels like something we should talk about too. That is crucial when your business is struggling with profitability. And it's not about cutting indiscriminately. It's about being smart and strategic. You want to reduce waste and make sure that every dollar spent is driving value.
Right. It's about ensuring that your cost structure is scalable, sustainable, and aligned with your revenue. Let's break it down into specific strategies.
Break it down? Is there a sound effect to go with that?
Wicca wicca.
I love it. So the first step is to perform a line-by-line review of your expenses. And we're not saying just glance at high-level categories, right? You need to dig deep into each line item to understand where your money is going. And you might be surprised at what you find.
Absolutely. For example, businesses often hold on to unnecessary subscriptions, redundant software, or services that aren't driving any value. It's easy to let small expenses accumulate, but over time they add up and chip away at your profitability.
And it happens all the time, right? We see clients often paying for tools that they're no longer using or services that they no longer need. Reviewing these regularly allows you to cut waste and ensure that your expenses align with your goals.
And another critical step is renegotiate contracts with your vendors and suppliers. If you've been a good customer, there's often room to improve your terms. Many suppliers would rather keep you as a customer and give you better terms than lose your business altogether.
100%. And I think that's why it's so important to really focus on strategic partnerships. You want to make sure that you're philosophically aligned. And we're not asking, obviously, for you to not honor your commitments, but we want you to have competitive terms with each of your vendors or suppliers. So extending your terms to be conducive to what's standard for the market. If you've currently got 30, but you're noticing that competitors are getting 60 or 90, that's going to dramatically improve your cash flow, and definitely a worthwhile conversation that you should be having with your partner. And also, when you're buying more, maybe ask for a discount on those bulk purchases or those long-term commitments. It just makes sense. We usually spend less at Costco than Publix, right?
Right. But don't forget to compare prices periodically. Just because you've been with the same supplier for years doesn't mean that they'll still sell the best option for you.
So a good old-fashioned RFP, right? Just to sort of take a pulse check and make sure that we're in the realm of reasonableness.
My favorite.
I love it. All right. So now let's talk about one of the biggest cost centers for many businesses. Are you ready?
Is it got something to do with labor?
My God, it's like you have a crystal ball. Yes, it's staffing and labor costs.
Oh, payroll.
Payroll. Labor is often one of the largest expenses, and it's vital to get this under control, but that doesn't necessarily mean cutting staff.
Exactly. Rather than cutting headcount, you should focus on maximizing the efficiency of your team. Are you getting the most out of your employees? Do they have the tools and resources to be productive?
I think those are great things to consider. I mean, we need to look at automating tasks or potentially outsourcing non-core functions. If you're paying high salaries for administrative tasks that could be completed more efficiently with automation or outsourcing, that's an area where you could save money without reducing output. And I have to say, we see this all the time in a lot of accounting and finance groups, right? Mm-hmm. Because there was a time where accounts payable was highly manual and it was primarily data entry. You could have 10 people for a $30 million company processing invoices. But today, if you're embracing technology and leveraging an OCR and optical character recognition software, you could have one accounts payable person. And it doesn't mean that we've let the other 9 go, but maybe we've repurposed them so they're operating at the top of their license.
Yes. Another option is adjusting work schedules. Could part-time or flexible staffing meet your needs? It's all about ensuring that your labor costs are aligned with your productivity and value your team delivers.
I agree 100%. And to me, that says we need to be nimble. So if we're in manufacturing, we need to make sure that the pipeline is lined up with the staffing, as it were. And if we've got fewer orders, that we're flexing appropriately. Otherwise, we've got folks on the line that are filing paperwork, which is just nonsensical. So I think that's a great segue to streamlining operations and processes. Operational inefficiencies really can be a silent drain on your resources. You might have unnecessary steps in your processes that are costing you time and money. So streamlining your operations can significantly reduce costs without impacting the quality of your product or service.
This might mean restructuring workflows or investing in process automation. If you have teams doing manual work that could be automated, you're wasting valuable time and resources.
Gosh, have you seen this before? Think about the repetitive tasks, whether it's invoicing, reporting, or customer communication. Automating these processes frees up your team's time for more strategic, high-value work. And as an added bonus, it often leads to fewer errors, which also saves money.
But there's another place you could be losing money, and that's inventory. Holding too much inventory ties up your cash, and holding too little can lead to lost sales. You need to find the right balance.
Stop it. People feel good when they have a warehouse full of inventory.
Right. The shelves look pretty. They're all lined up and stocked.
But you want to optimize your inventory turnover ratio. So keeping enough inventory to meet demand without overstocking. Because holding excess inventory costs money, storage, insurance, and also the risk of potential obsolescence. You're tying up capital that could be used elsewhere in the business.
Implementing better inventory management systems and just-in-time inventory practices can help you maintain leaner operations and reduce carrying cost.
What do you mean just in time?
You have an order, you have the supplies just in time.
My gosh. So funny. And that's a technical term, isn't it?
It is.
You didn't just make it up.
Just in time.
All right. So another thing that we could consider, reducing overhead costs. Overhead expenses like rent, utilities, and insurance can eat into your profit margins, especially if you're not regularly reviewing them. One of the easiest ways to save on overhead is by negotiating rent or potentially right-sizing to a more cost-effective location.
Or, if possible, downsize your office space. With more companies embracing remote work or hybrid models, you might not need as much office space as you once did. Downsizing can result in significant savings on rent and utilities.
And we have a client that's actually considering that now. They procured a big, beautiful space in 2019, right? And then after the pandemic came, they really reevaluated how they were operating. And now they've got remote and hybrid, and they don't need that giant office that they have.
Right.
So we are looking at a couple of different alternatives to make sure that that capital is being deployed in the most meaningful way. Another thing we did with them, speaking of RFPs, we shopped around their insurance, and we found that by switching providers and bundling services, we were able to save almost $100,000 and get even better coverage with better retention. So lots of opportunity. You just have to shake the tree and see what's going to fall out.
Right. A lot of companies overlook this next one, investing in energy efficiency. This can lead to long-term cost savings, whether it's switching to energy-efficient lighting, upgrading HVAC systems, or investing in solar energy. These changes can reduce your utility bills and have a positive impact on your bottom line.
She is the reason that I have a giant recycle bin in my home. Could fit like 6 people in that recycle bin. And it's not just good for the environment, but it can also improve your brand's reputation and potentially qualify you for tax incentives or rebates, which would further reduce your costs. All right, now that we've covered both the revenue and cost sides, let's talk about managing cash flow for companies that are losing money. And this is often a lot of folks' situations. So Robin, why don't you kick us off?
Sure, Michelle. One of the most important things to do when cash flow is tight is to shorten your cash conversion cycle. That's the time it takes to convert resources into cash from sales. The faster you can move that money through your business, the better.
So float less cash.
Yes.
All right. I agree with you. So start by speeding up your accounts receivable. Don't let customers stretch their payments too far. You probably should automate your invoicing and then follow up promptly on late payments. And if it makes sense, consider offering discounts for early payments if that velocity of cash is critically important.
And on the flip side, try to extend your payment terms with suppliers. This can give you a buffer to keep cash in your business longer. It's about keeping your money as liquid as possible while still maintaining good relationships with vendors.
Always. We always want to honor our commitments. We also want what would be market terms.
Yes. So maybe there's something we can recommend.
Stop. What is it?
A 13-week rolling cash forecast. This is one of the most effective ways to manage cash flow, especially when things are tight.
You guys, she really is talking very nerdy to us. The 13-week rolling cash forecast is essentially a week-by-week view of your cash position for the next quarter. It helps you anticipate cash shortfalls and manage liquidity proactively. You can also pair it with scenario planning. What happens if sales drop or you have a major expense come up unexpectedly? Pop it on in.
Exactly. By forecasting and planning for different scenarios, you'll be in a much better position to manage your cash, even when you're losing money. And we may have an example.
Stop it. The room is very excited. The tone, it's palpable. I can feel it.
So first we have the 13-week rolling cash forecast for a company that is losing money. Cash is very tight. Bank balance is getting lower and lower. So we start out with our customer payments. It looks like we're receiving customer payments around the same time every month. So this looks like maybe a service type business. We have our payroll. It looks at least twice a month. And then we have an owner of the business that is receiving distributions or transfers. We're having to pay our taxes on the payroll and all that. And then
why
the pesky IRS makes us do that. And then it looks like there's an office space. So we've got rent and the various expenses that go along with having office. Looks like we got some marketing campaigns going on, maybe a podcast. I don't know. Let's see. Everybody should have a podcast, right? Then our insurance to cover our employees and to possibly cover the items with our office and things like that. And it looks like we're running a lot of our expenses through a credit card, which we pay monthly when it's due. So if we keep going at this rate, there is a dip specifically in December, where our bank balance will be going the wrong way. So we can't really have that. So we need to think about what we can do. Well, we've put together some scenarios.
So you've got a whole other slide that you're showing now?
A whole other slide that I'm showing. So we reached out to some of our customers and we said, you guys, you kind of aren't paying timely. Can we get the payments coming in when they're actually due? So we were able to go through and see that 60% were aging past the due date, and we were able to get that 60% to come in a week earlier, which is great.
So they were stringing out the payments to begin with.
Stringing out the payments.
All right.
Okay, that's our money.
And we want it now.
Yes.
Who was that, J.G. Wentworth?
It is J.G. Wentworth. Payroll did not change, so it looks like, staff is as usual. Transfers to owner, however, for temporary or for the indefinite, the owner has decided to take a lower distribution, which is very helpful. Taxes stay the same. Rent and office expenses look like they're pretty much the same. Marketing, it looked like we have cut our marketing budget almost in half. And then possibly room to ramp it back up once we get on the other side of this. Insurance, we shopped around for some insurance and we were able to get a $500 relief on the policies that we had. And then we went line by line through that pesky credit card to see what we were spending all that $10,000 a month on, and we were able to eliminate $2,000. A lot of it was related to meals and entertainment and subscriptions that we weren't necessarily using anymore and things like that. So what that does is, even though we're still tight, we're still not necessarily making money on the P&L. We are getting our cash a little faster, and we've figured out expenses that we just don't need, and it's helped our bank balance stay pretty steady.
So we value confidentiality. It's incredibly important. This is clearly a professional services firm, and it might be a tax accounting firm, as it were, maybe a CPA firm.
Right.
And we know that a lot of their revenue is going to be coming in the first maybe 4 months of the year.
Right.
And so to me, it looks like there's pretty gnarly seasonality. And so when you've got this lumpiness with the timing of your sales, you don't have that good, consistent, recurring revenue month over month, which not a lot of organizations do have. It's incredibly important that you are thoughtful as it relates to your cash planning. And so we know, I want to say, in probably the first 4 months of the year, they're going to bring in $600,000, right? But at the end of the year, it's dribs and drabs.
Right.
Well, they would be dead in the water if they didn't start to make some changes.
Yes, and as they build it out into the next year, maybe consider all that money that's coming in those first 4 months to budget and adjust expenses accordingly throughout the year.
It feels like you just said exercise some discipline. Robin is if you could see her with the ruler sort of waving her hand about, she is very, very strong when it comes to expense mitigation and management. And so I think a lot of great things were done here, and the outlook looks different.
Yes.
So again, that was fantastic. Love all of it. Sometimes even with the best cash management and cost control, you do still need external support. And that's where working with banks or lending institutions can help.
Yes, a lot of business owners don't realize the different funding options available to them when they're facing cash flow challenges. For instance, working capital loans can be a great option to cover day-to-day expenses if you're going through a rough patch.
Yes, they make me a little bit nervous, right? Because we need to make sure that the business is right-sized and that it's optimized and that we're not just putting a Band-Aid on it. I really prefer a flexible line of credit. It is like Gumby, right? It's a flexible financing tool that lets you draw on funds as needed, which can be a lifesaver when cash flow is uneven, like what we just saw.
Right. The key is to find the right type of financing for your situation and work with lenders who understand your business and are willing to help you through the ups and downs.
Again, I think that partnership is key, really making sure that the people that you're working with understand who you are, what you're doing, and really buy into that mission, vision, and values. Well, I hope today's episode has given you some concrete steps that you can use to improve your cash flow and profitability, especially if you're currently in the red. It really is all about balancing revenue growth with cost control and managing your cash with precision.
And don't forget, if you're struggling with cash flow or need outside support, there are funding options available. whether through loans, lines of credit, or alternative financing options.
And speaking of financing, don't forget, next up, we'll have Delilah Berry, an attorney with Blank Rome, joining us to talk about negotiating financial instruments and how to secure the right type of financing for your business. It's going to be a great conversation.
Thanks for tuning in to Talk Nerdy to Me, an entrepreneur's financial guide. We'll see you next time. Until then, keep working smart and stay financially savvy.
But don't forget, as always, we'd love to hear from you. Subscribe to the podcast, share it with your network, and leave us feedback. You can reach us at thewilliamstanleycfogroup.com. Let us know what topics you'd like us to cover or any questions you have. Until then, keep nerding out. Okay?
Bye.